one month in 2024 that looked like proof he was doing fine. The Atlanta web designer brought in $6,000. Then 2 clients left. 3 slow months followed. The money did not vanish in one dramatic mistake. It arrived at the wrong time, left in small pieces, and turned a strong month into a test of rent, taxes, health costs, and self-control. Malik is a hypothetical freelancer in Atlanta, Georgia. His sample annual income is $58,000. That number is an assumption for this story, not a fact about a real person. The key problem is simple. He may earn enough across the year, but income does not arrive like a paycheck. One month can be full. The next can be nearly empty. A regular worker can often plan around the same pay dates. Malik could not. A client might approve work late. An invoice might sit unpaid. A new job might look certain, then fail to start. His bank balance showed cash he had today, not income he could count on next month. That small difference changed every choice in the home. The $6,000 month created a quiet trap. It felt safe to use the money because the work was finished and the payment had arrived. But gross income is not the same as spendable income. Gross income is the money earned before taxes, health costs, business costs, and other needs are taken out. A full account can hide several future bills. Malik needed to divide that payment before it began to feel like normal pay. Some money belonged to the IRS. Some had to support the business. Some had to cover personal needs during the slow months. Only what remained was truly free to spend. Without that split, the strong month became a promise made by money that was already needed elsewhere. The first pressure was rent. Rent does not wait for a client to pay. It does not shrink because a project ends. When Malik looked at the next few months, the question was not whether he had earned well. The question was whether cash would be in the right account on the right day. That is a cash flow problem, not only an income problem. His first useful step was to stop treating every deposit as a paycheck. He gave the business money a job before using it. One account held tax money, another held business cash. His personal account received a planned amount. This planned amount was his baseline paycheck, a steady transfer he could use for home needs even when client income moved up and down. The baseline did not make Malik richer. It made the truth easier to see. In the strong month, he did not suddenly have $6,000 for rent and spending. In a weak month, he did not have to guess whether a large payment was safe to use. The system slowed the money down. That delay gave him a small wall between a good invoice and a bad month. Quarterly taxes added a second clock. In the United States, self-employed workers may need to make estimated tax payments during the year. The IRS uses these payments, so tax money is sent in during the year instead of waiting for one large bill later. The exact amount depends on the person's income, deductions, and tax situation. Malik's numbers were estimates, not personal advice. That word matters. Estimates are not magic numbers. They are a forecast based on what Malik thought he would earn and what he thought he might owe. If 2 clients left, the forecast could change. If new work arrived, it could change again. The danger was not only paying too much or too little. The danger was spending tax money before the estimate was ready. Malik's tax account made that risk visible. Each strong payment sent money away from daily spending. The move could feel painful because the bank balance fell right after an invoice was paid. But the money had not been lost. It had been protected from a future claim. A tax account is not a reward account. It is a holding place for money with a known job. The slow months showed the cost of the old habit. When income stopped, Malik still faced rent, health costs, food, phone service, and the basic tools needed to find more work. A business can be profitable over a full year and still run out of cash during a bad stretch. Profit looks backward. Cash flow asks what can be paid now. That difference changed his daily behavior. A new tool that once looked affordable became a question. Could it wait? A meal paid for with a strong month balance became more serious. Was that money personal pay, tax money, or a reserve for the next empty month? The issue was not shame. The issue was that one account had been asked to answer too many questions. Late invoices made the pressure worse. Malik could finish work and still wait for payment. Until the money arrived, the invoice was not cash. It was a claim on cash. That claim might be valid, but rent could not be paid with a promise. He began to track work that was done, bills sent, payments received, and money still owed. This record gave him a clearer view of the risk. A full list of unpaid invoices could make the year look strong. A weak bank balance could tell a different story. Both facts could be true at once. Malik did not need a bigger story about success. He needed to know which dollars had arrived, which were late, and which were only expected. Client deposits brought another hard choice. A deposit can feel like profit because it is money in the bank, but a deposit may be tied to work that is not finished. It may need to be returned if the project ends early, depending on the contract. Malik treated a deposit as restricted cash until he met the work terms. That choice reduced what he could spend today, but it lowered a future shock. The lost clients also changed his time. Malik now had to sell while trying to work. He had to follow up on invoices, seek new projects, and keep current work moving. Each unpaid bill carried a cost beyond the missing money. It used attention. It made planning harder. Uneven income can take time from the very work that could repair it. At home, the budget had to become more honest. Malik separated essential bills from flexible spending. Rent and health costs came first. Food and basic service needs followed. Optional spending waited for money that was truly available. This order did not remove every hard choice. It made the hard choices clear before the account reached zero. Health costs needed special care. A freelancer may not have an employer plan helping with part of the cost. Malik had to keep health coverage in the monthly plan, even when work was slow. Skipping protection might lower cash needs for a short time, but a medical bill could cause a much larger break later. Insurance is not a promise that every cost disappears. It is a way to limit one kind of loss. Debt could also turn a slow month into a longer problem. If Malik used a credit card for rent or taxes, the bill would arrive after the weak month. Interest could keep growing under an APR, the yearly cost of borrowing. The card might solve the day's problem while moving the pressure into future months. That is why borrowed cash must be shown as a new bill, not treated as new income. His order became plain. Protect money for taxes, keep the business able to work, cover rent, health costs, food, and other essential bills. Build a reserve for slow months. Pay down costly debt. Only then consider long-term saving or investing. This order is not a law for every person. It is a simple way to keep urgent needs from fighting with future goals. The reserve was the part Malik had once put off. Saving during a strong month felt less exciting than spending it. Yet the reserve had a clear purpose. It was not for a vacation or a quick purchase. It was for the gap between paid work. The goal was to give his home time to breathe while he looked for the next project. That reserve also changed the meaning of a client loss. Before, losing 2 clients felt like an immediate threat to every bill. After the account split, the loss was still serious, but it was easier to measure. Malik could ask how long his essential cash might last, what invoices were pending, and what work could replace the lost income. Fear became a set of questions. The most important lesson came from the $6,000 month. A high month should not set the size of a freelancer's life. The baseline paycheck should come from a careful view of the year, not from the best deposit. If the baseline is too high, slow months force debt. If it is too low, life may become needlessly tight. The right number is uncertain and must be tested. Malik also learned that more income was not the only answer. More work can help, but more work with late payment may not fix the cash gap. A larger invoice can still leave taxes unpaid. A busy month can still lead to an empty month. Stability comes from both earning and timing. It comes from knowing when money arrives, where it goes, and what it cannot be used for. The IRS rules make tax planning a real duty, not an optional task. A self-employed worker may owe estimated taxes during the year, and underpayment can lead to a bill or penalty. Malik would need current IRS guidance, his own records, and qualified tax help when needed. The story gives no personal tax answer. It shows why guessing after the money is spent is a weak plan. The same care applies to the $58,000 sample income. Annual income alone cannot tell us whether Malik is safe. We would need to know when he was paid, what business costs he had, what health plan he used, what taxes he owed, and whether debt was present. Without those facts, any exact leftover amount would be made up. Honest planning keeps the unknowns visible. By the end of 2024, Malik's win was not a huge check or a perfect month. It was a new path for each dollar. Client money no longer went straight to personal spending. Tax money had a separate home. His personal pay had a limit. Slow month cash had a purpose. The system could not stop clients from leaving, but it could stop one bad month from controlling every account. A freelancer facing the same problem can begin with 1 month of records. Mark each payment by the date it arrived, not only the date the work was promised. List essential bills. Set aside money for estimated taxes in a separate account. Choose a cautious personal transfer. Hold deposits until the work terms are met. Then review the plan each month as income changes. That move may feel small beside a $6,000 month. It is not. It changes the question from how much money came in to what each dollar must do next. For Malik, that was the difference between looking successful and being ready. Uneven income does not become steady by wishful thinking. It becomes easier to live with when timing, taxes, and trade-offs are faced before the money is gone.